Let's go.
What's up, everybody? It's your guy, Frank the Tank, and welcome to Let's Be Frank podcast. Super excited about today's episode. We have a special guest, mortgage loan branch manager, originator for the past, I think 25 plus years. Excited for him to share his expertise with us and his journey. Myself, I'm also a loan officer as well too. I'm also licensed with the company we got going now. He is an executive partner of Leveled Up Loans. And without further ado, I'd like to introduce Mr. Kerrick Patterson.
Thanks, Frank. Glad to be here. This is fun. So like Frank said, I've been in the industry I'm pushing into my 25th year. I started in 2000.
It's amazing, man.
I worked, you name it, I've worked there. I worked originally for brokerages and some direct lenders back in 2000, went through the whole subprime era. Went through, the market crash.
Give us your whole, I want to know your whole LO journey. Like, when did you get licensed, or all the way up until now? I'm curious.
So I actually, believe it or not, I went to film school at Cal State Long Beach. I worked in the film industry for 7 years and thought, that's what I wanted to do, and learned real quick, especially through internships, that it's just too difficult to be successful in that industry. So my brother-in-law was doing 125s, and most people don't even know what a 125 is.
Yeah, what is that?
So that's when you were able to borrow up to 125% of the value of the home in cash.
Oh, wow.
They were real ugly loans, but if you wanted the cash, they were out there. So my brother-in-law was doing those. And said, hey, you should get into mortgage. It's hot. And I just graduated. I'm like, and I already had my real estate license. I just got it for whatever.
Oh, I didn't even know you had your license.
I did. I don't have it anymore.
Okay.
But so I was like, all right, yeah, let's give it a go. Let's give it a try. Because I was bartending prior to that. Bartender, going to school.
Wow.
And so got into it, and I was in the military for 10 years as well, and I
forgot you're a vet, so I do want to thank you for your service.
Thanks,
there.
Bro. Yeah.
That's amazing.
Thanks. Yeah, 10 years in the Army. I was a field artillery unit blowing up stuff, and I was a hydraulic turret mechanic. So I'm kind of wired in a way where I need to know everything about what I'm working on. Like, if I'm working on a hydraulic turret, I want to know how everything works. I don't want to just look at a tech manual that says, change this piece out and it should fix your thing. Why? Why did that break? What is that piece? What does it do? I'm that kind of guy. I need to know everything.
Yeah.
And so when I got into mortgage, it was the same way. Most everybody I knew in the industry was like focused in some niche subprime thing. This guy's doing this, and this guy's doing this niche. And none of them, including my brother-in-law, wanted to learn how to do anything else within the industry. They were just fixated on their one little thing and their one offering, and if it didn't fit their box, they'd get rid of it and just go on the next one. I was wired in a way where I wanted to know everything. I wanted to know what every product was. I never wanted to just pass them by because I didn't know where to take them and just go to the next deal. I wanted to be able to find anywhere and everywhere. I never wanted to lose a deal.
Yeah. So you came in during the subprime era?
Yeah, 2000.
I'm so to this day, I hate that I missed that era. I mean, I was told that back then, all you had to do was have a heartbeat and you got a loan.
Yes.
Is that how it was?
Heartbeat, fog and mirror, and everything was equity based. So they didn't care if you defaulted because they knew that the homes were increasing so fast in value that if you walked away, they're gonna clean up.
Wow.
And then the other thing was those subprime loans were kind of structured like a balloon loan. Balloon loans, it's fixed for X amount of years, and then when it gets to that maturity date, you got to pay the whole thing off.
Oh, wow.
Well, in a subprime loan, most of them were fixed for 2 years, some as short as 1 year. So you had a fixed rate period for 1 or 2 years, and then at the end of it, it would adjust to something that was astronomical, that was unaffordable.
Those are the ARM loans, right?
Yeah, they were the ARMs. So they'd adjust to an adjustable rate that they couldn't afford, and so they were forced to redo the loan again to put it back in another 2-year fix and just keep that thing going. Wow. So it was just one after the other.
Crazy.
Is the way that worked.
So you entered during the subprime market, and then we all know it freaking tanked.
Oh yeah.
So what happened when everything started imploding? How did you guys adjust?
Yeah, it's a great question. So when the market crashed, it was literally, and this is why I always tell all my loan officers, not till the fat lady sings do you count your chickens, because I had loans that closed, funded, Wire left the bank, went to escrow. Escrow had the wire, sent it to the investor that we did a loan with, and guess what? That investor had imploded in the middle of all this. They no longer existed. They unfunded the loan and unwired it, and we lost the whole deal. I had multiple deals like that happening. It was insane. All of them. WAMU, you name it.
Really?
IndyMac, all the big guys. They were just imploding left and right. There was actually a site we'd go to called Implodometer. I think it might still be up, where you can go on there and look at all the banks as they were popping and closing and shutting down. It was insane. It was crazy time to watch. So when that happened, there was literally, for a long period of time, no loans to be had at all. Like everybody was pulling back. All the investors fell away. The big guys were holding back. And so it was a scary time. When that happened, a lot of people were defaulting, so we got into loan modifications.
Oh, yeah, yeah. I actually did a couple of those myself, too. I worked for an attorney. We actually
did mods.
Processed a lot of that. Yeah, so that's how I didn't adjust. I got into it. There
was a market there. There was money to be made. So we were trying to make money somehow, some way. And that's all that we had for that time. So we did that for a while.
So much work, huh?
Yeah. And then things just kind of bounced back after that. Things started popping again. The market started coming back. But by then, all these regulations came into play.
Right, Dodd-Frank
came in and just took our commission away and made one dude rich instead of, us loan officers getting the lion's share. Now the banker gets the lion's share. We're all scratching for peanuts.
Insane.
Padding their margins like crazy, making the rates higher than they really are. It was awful. It still is. Still that structured that way now. And then, they required us to get licensed through the NMLS, right? And the reason.
So you didn't have to be licensed back then?
Prior to that,
really?
There's no license requirement. Prior to 2008 crash, anybody could do it. You didn't have to be licensed.
Anyone can originate.
Mm-hmm. Anybody.
Really?
Yep. In a direct lender, brokerage, retail bank like a B of A Wells. You didn't have to be licensed any of them. You still don't need to be licensed for B&A of Wells. You have to be registered with the NMLS, but you don't have to be licensed.
Right, yeah. That's insane. So you can be a mortgage loan originator back then with no license.
No license, yeah.
Sheesh.
But then they wanted to be able to track every single file closed right to the loan originator. And that's why they implemented that, to give us a registry number that goes on every single file moving forward.
Wow.
So they can, instead of go back and blame the company, they can blame the individual.
Oh, okay.
And put the blame on them. So
interesting.
That's kind of how it all evolved, and that's how I've been through all these crazy markets.
So when you got past those markets, and you went past the loan mod, era. When did stuff start picking up for you again in the mortgage world?
So
2011, 2012.
Yeah, it's about 2011, 2010, 2011. We had a FHA boom, an FHA refinance boom. So a lot of those people that were in FHA loans, rates had come down. There's an opportunity to refi them, and so that kind of kicked us off. But prior to that, again, we were just scratching. The other thing I did prior to that happening is I got involved with REDC, which is the big auction houses back in the day. So during the market crash, if you recall, in 2008 to 2010, tons of REOs. Everybody was foreclosing. And so Countrywide had a massive book of these REOs that they were on their own books. And they were asking us to go out and do open houses for these REOs 2 weeks before the auction. And so I get out there and they give me a book of all the houses around the neighborhood, like 100 houses that are all going for auction, starting at $30,000, $60,000, like these crazy low amounts. And so I get the guerrilla mindset. Hey, I'm gonna go to all these houses around the neighborhood. I'm gonna go to every house that's in this book and do 100 flyers for, and put them in people's doorsteps all the way around that one house. So 100 on this house, 100 on this house, 100 on this house, to let them know, hey, this house is going to sell for under market. It's going to kill your equity. Let me show you how to preserve your equity by doing a cash out refinance. That was my angle.
I like it.
My phone rang off the hook, but not for my solicitation. It flew off the hook because they're like, how do I buy this house for $60,000? They didn't care about the angle I thought was good. They cared about buying that house for $60,000. So I immediately flipped my marketing. I'm like, house for sale, auction home, $60,000, blah, blah, blah.
Right.
And my phone was blowing up. I had zip tied signs to every off ramp and on ramp from
smart.
here to Orange County saying, buy these homes. And while I'm putting these signs up, my phone's ringing off the hook with people saying, how do I get this home? How do I get this home? So I went to the auction houses. I brought my people. They paid me 1% for anybody that won the bid on their house, to the point where Countrywide was like basically saying I'm stealing customers out of the parking lot, which is a total lie.
Wow.
They restructured their entire way. They were able to bring people in. I had to register and whatnot. And I did so good at that. Countrywide's like, we need you. You're insane. You're a crazy girl marketer. And they hired me on, and I worked with them for a while until B of A bought them out, and
You're done.
Yeah. So that was the other little piece of the history after the market crash up until the mortgage market came back.
Right.
Probably around 12, 13.
So after all that, and when everything came back, I know you were telling me something about you used to work for the big companies too. What was it, Cash Call or
Cash Call, Greenlight.
So you actually were originating for them.
Funding. Oh yeah.
And then you after that you transitioned into your own.
Yeah, that's
what's
a
the
great
story with that?
Yeah, that's a great story. So every shop I worked in for 13 years were all lead providing type shops, the big shops, and those big shops, they're just like puppy mills. They're like grind houses. Like you go in there and you're in there with 700-800 loan officers all in cubicles squeezed together, and they're just feeding you leads. I call it the baby bird syndrome. All these guys with their mouths gaping open, waiting for mama bird to shove the lead down their throat, and they're padding on these fat margins on the rate so you can't make anything, give you very little pay per the Dodd-Frank Act, but they're keeping you there because they're feeding you enough just to keep you alive.
What were you making per loan? How much were you making?
Shoot, anywhere from like $700 per file, doesn't matter how big the loan is,
Jeez.
maybe up to like $2,000 if you're lucky, if you hit volume, right? But when they trap you in those environments, you don't go out and hustle your own business to try to where you can obviously
they make you almost dependent on them, right?
They make you dependent.
They make it so easy.
Yeah.
And
exactly,
it's almost like a sweatshop, right?
It's a sweatshop.
It's insane.
A complete sweatshop, for sure, 100%.
Yikes! It's crazy. It blows my mind because of what we're doing now here at Leveled Up Loans. It's like each LO here, they're making about what, 2 points?
2 to 3 points on average, yeah. So someone on a $500,000 loan can make $15,000 here on a lead provided to them versus going to work for like a Quicken where you make $700 on the same file.
That's crazy.
And you've got no life because they're just pounding you with leads, so you got to grind for 12 hours a day and come in on Saturdays. And I worked in all those environments. I know.
So on average, what do you think you were doing as far as like files a month?
So in my heyday, I was probably closing 20, 30 loans a month.
With those big companies?
Yeah, the big companies, yeah. All the lead providing shops.
Wow.
Which meant I had zero life.
Zero life. I can only imagine. So much goes into originating, a file.
And those shops make you do a lot of the back end admin stuff.
Oh, they do.
They make you do disclosures and change of circumstances and tracking stuff down and pulling stuff that a loan officer should never have to do, because our forte, what we're good at, is selling.
Right.
We're good at analyzing and presenting
the product
benefit.
Right.
Yeah. Not chasing paper. We chase paper half the day. We're not doing what we're best at, which
LOAs
is getting the
are
next
for, right?
deal.
Yeah.
Get an LOA, your processor, which we have here, that will track all that stuff down for you and keep you focused on getting the next deal.
Yeah. So, I mean, it's crazy to me because I think, the way we're going to do it here, we're going to provide, so many leads like these big companies did, with Paul and all the marketing, techniques they've built out through the years, the way you've seen it. So I think we're going to be able to provide a high volume of leads and actual loans, but they're making full pops. So that's going to be so great for these LOs, their families. We're not trying to get rich off them. We're just trying to provide a spot.
That's the thing. We're not greedy. We're not massive like these shops that have this crazy amount of overhead and all these layers of management, right? Compliance and marketing, and all these layers. And so all those layers and all the bigness and all the brick and mortar and all this overhead translates into higher rates, less comp, right? And we don't have that here. We're keeping it thin. We're keeping our margins low so we can be super competitive. And we're not marginalizing the rates to put all the comp in our pocket.
Right.
You guys are getting the lion's share. Like, you're getting a massive percentage of the overall total yield. We're going to make it up in volume on the back end as managers and as principals here, and we know by doing it that way, we're going to have every top sales guy that knows how to crunch and work leads.
It's going to be so good.
Beating our doors down. Yeah.
It's going to be so good.
The Quicken guys, the top Quicken guys and Loan Depot and all these guys, when they get wind of what we're doing, and they can make so much more per deal with better rates and independence and not kill themselves, and they know how to work these leads and grind them to the finish line. It's going to be insane.
I think we're going to have to hire some more LOAs.
We're going to have to hire
some more processors. Yeah.
But we're crawling before we walk, before we run. We don't want to get so big that we fall apart. We have to be able to manage it as we grow. So
I like it.
We're doing that.
Speaking of rates, I want to ask you a question. From your experience with your knowledge of the bond market and how all that works, people are out there, they're confused. They're like, well, hey, we just saw the Fed, they lowered the Fed funds rate.
Yeah.
Why are rates still going up? Why are they at 7% again? What's going on there?
Fantastic question. So everybody, whenever the Feds announce that they're going to lower the Fed funds rate, everybody automatically assumes that's going to bring mortgage rates down. The Fed funds rate is the rate that they loan our tax dollars to the big financial entities who then loan it to you and I, the consumer, but not a mortgage. It's directly related to things like credit cards, cars, things like that, not mortgage related, right? What happens when the Feds do that and they raise the Fed funds rate or lower the Fed funds rate, it's sending a message to Wall Street saying we need to raise rates because there's inflation, or we need to lower rates because the economy's poor.
Right.
It's the whole reason they do it. If inflation is high, how does inflation get high? This microphone costs $200, right? But now all of a sudden there's a demand for these microphones. I've only got so many. And I got everybody and their mama asking me for this microphone. Well, I'm going to raise the price on it to $300 because I can, because there's a demand for it. That's inflation, right? Now, and the reason that people want to buy this thing, and they're even willing to pay $300 for it right now, is because they're going to finance it for 2% interest rate because rates are low, right? And it makes sense. It pencils for them. I'll do it. It doesn't matter if it went up $100.
Right.
But if the opposite happens, and the rates go up, and now I can't purchase this thing for 2% interest rate. I got to purchase it for 7% interest rate because that's where they went. I'm not buying that microphone anymore. It's too expensive at 7%. So they walk away from it. Now they got all these microphones, and they can't sell them. So what do? They drop the price back down to 200, maybe even to 150, so they can get rid of them. That's how they curb inflation. Bring prices down by raising rates. Nobody buys. They have surplus, and they bring that down.
Right. So why is it that when the Fed just recently dropped rates, what does affect mortgage rates? Why did the bonds go up?
Yes. So the bonds. So let's talk about bonds. So the bond market, the 10-year Treasury note, is the main market that directly affects mortgage rates, right? And so the bond market, especially the Treasury bond market, is a safe haven for money. You don't, as an investor, earn a whole lot in bonds like you can in stocks. Stock market is way more volatile, but there's opportunity to make a lot of money when things are looking promising. Than you can if you put in bonds, but it's a safe place. So if there's uncertainty in the market, economy's uncertain, anything like that, investors are going to pull their money out of stocks and put them in bonds where they know it's safe. They're not going to lose it.
Right.
But if they feel like things are going to be good, then they pull them out of bonds, stick them in stocks where they think they can make more money.
So is this an indication people think that things are going to be bad? Is this a forecast for what's to happen this year? Or what's your opinion?
So bad for you and bad for the consumer, two different bads, right? Bad for you and me is no coronavirus. We like...
That was a wild time, too.
We like uncertainty because uncertainty in the market pushes money to the bonds, which makes our rates better, right? If things look fuzzy and warm and rainbows and butterflies in the market and they think the economy is going to do good, then they pull their money out of bonds, stick them in stocks, right? And so that's what's happening right now. Why did that happen even though the Feds lower the Fed funds rate? Because typically when the Feds lower the Fed funds rate, they're basically saying we need to make money cheaper because the economy is not doing good. We need to stimulate the economy. If we make the money cheaper, then people will spend money, it'll stimulate the economy, and blah, blah, blah. And when they see that sends a message to Wall Street, hey, they're gonna do something to help stimulate the economy. Let's pull money out of bonds, stick them in stocks.
So you're saying we need some chaos in this country?
We need chaos for that. That helps us in some respect, but not always. The other two main things that we look at every single month is the jobs report and the CPI numbers.
Right, I saw that.
So the jobs report tells us every month. And there's predictions and analysts in the Feds that say we expect job numbers to come in at X based on their
And they
data.
just recently went up, I saw,
And
right?
they went up. Now, when they go up, that's bad for us.
Right.
Why? Because they're saying that the economy is, people are hiring. There was a lot of jobs in the government sector, a lot of jobs coming up in other sectors, and way, way higher than what they predicted. I think they predicted like 1.7 and it ended up being like 2.4. It was like astronomically better than what they expected.
So that wasn't the average like seasonal and holiday hiring?
No, because that's already gone. Now we're in January. Those people are already gone from their seasonal jobs. So these are numbers for real jobs. And although a lot of them are government, so a lot of them are like don't hang your hat too much on the government ones. But the fact that the jobs market's good. Remember, whenever there's jobs, a lot of jobs, and those numbers come out favorable, what is it saying to investors on Wall Street? These people are hiring because they have demand, and that demand means that people are going to buy. And if they buy, we're going to invest in those companies because we're going to earn a bunch on their stocks, right?
Right.
That's what happens. CPI numbers, that's the next one. That's
core inflation.
Yeah, core inflation. So we're looking at the inflation numbers, and when those come out, we're looking for...
I heard those were spot on, so that's a good sign.
Yeah, they were spot on, but they didn't, sometimes if they go up or down, obviously, then we're going to have some movement based on that.
Right.
So if they move, let's say if inflation is high, then they're going to lower the Fed funds rate again, maybe stimulate things. Or if they're steady, maybe they're like, okay, well, we see consumer confidence with this new administration. We see, and we can see that because all these companies are hiring like crazy. So, bam, they're expecting things. And so everybody's on the bandwagon that we're going to have a good economy. And so that makes our rates suffer. We know that the next administration coming in is fantastic at manipulating our market and bringing those rates down in other ways. And so we're all hoping.
Fingers crossed. I'm praying. So let's see what happens. It's going to be interesting.
Yeah, for sure.
We got some good news recently from you follow Barry Habib, right?
Yes, I do.
So this guy's phenomenal. He's got the Crystal Ball Awards for accurately forecasting.
He's the most accurate forecaster in our industry.
Amazing dude. So he just had his annual conference, the Accelerate conference, and I was trying to brush up on it in the past couple of days. And he has a positive outlook for us, so that gave me some confidence. And what he's saying is he thinks that home prices are still going to be appreciating from 3 to 4% a year,
I believe
which is good
because of demand.
Exactly, supply's still low. He understands we're at 7% right now, but he's forecasting that rates should be between 5.25% and 6% this year.
Awesome.
So that would be phenomenal. I think that'll give us a big,
boost.
Step in the right direction.
And just FYI, everybody that's watching this podcast, I did the analysis. Everyone's been crying the last couple of years about how horrible the rates are, and we talked about this in one of our meetings. But so I pulled the last 70 years of interest rates from high to low.
This is going to be gooder.
I added them all together, and I divided by 70 because I want to know what's the 70-year average. Everyone's crying. Guess what the 70-year average is? 7%.
Really?
It's right where we're at. So, we just got spoiled through all these markets.
Right.
We got spoiled with when the market crash happened in 2008, the Feds lowered the Fed funds rate to 0. Then we had the China wars, not literal wars, the economic wars, where they're the trade wars.
Oh, the tariffs.
Yeah, they put all the tariffs and stuff. So that caused our economy to suffer. So Feds lowered the Fed funds rate to 0 again. And then we had the third event, which was COVID. They lowered it again. So all this from 2008, and then, they tried to trickle it up and then it dropped right back down because of all these events.
Right.
But we're, these last since 2008 to date, we've all been spoiled rotten with these rates. We think, we want to be back in the 2s or the 3s or the 4s. None of those were realistic rates based on the real market. It was based on manipulation of the government. We are actually in a real normal market right now, and 7% is a 7-year average. These are not horrible rates. They're just horrible in that 7% plus a $500,000 loan amount. That makes it
So do you think this is the new norm? Do you think we'll ever see 3 and 4% 4% again, or
I don't know. I mean, there can have to be something, I think, pretty dramatic that happens. Another pandemic or something to get us down there. War's always great for,
We don't like war, but it's good
we don't
for
like
rates.
war, but it's
I
good for
totally
rates.
get that.
I'm not praying for war. I don't want war, but
you know, one thing I don't get about some people saying, something to the effect that you would say, like, well, hey, back in the late 80s, rates were 15%.
Yeah.
You know what I mean? But my pushback
to 20%.
My pushback on that was, the properties weren't nearly as expensive.
And
so that's the big
that.
difference, I think.
Yeah, I've done the math on that. So I did the math on. Actually, that's near. There was rates at one point in the 80s when they were up to 18%.
Wow.
So I looked at the average home size or sell size in that year, and I think it was like $60,000.
See, that's crazy.
And so you do $60,000, and you figure out what the payment was on that. And I did the math on it because I also pulled the average income during that time frame to see how much of their income had to go towards paying that. It was about 50 to 60% of their income just for the mortgage alone during that time frame. So
I didn't know that. That's interesting.
Yeah. So I like to play with numbers.
I like that. I like that. And that's why we love working with you, man.
Yeah.
That's crazy. Wow. So average DTI back then, 55%.
55, 60%. And so a lot of people weren't even getting loans.
When you ran those numbers, what were the payments looking like at 18%?
I forget exactly.
Give me something approximately.
So I know that the average income I think back then was around $48,000. So I'll do
a year. Okay.
Yeah. So actually I think it was even less than that. But let's call it 40.
Sure.
40,000 divided by 12 is 333 a month. I don't even think it was that much, to be honest. And then so probably around $1,500 a month or so was their total payment for a house back then at that interest rate.
Yeah, that must have been high for back then.
You figure
that was the average in 2012. So that's
yeah. So I'm sure there wasn't a whole lot of activity purchasing back during those high rates, but it was what it was. And mind you, that all happened because of the savings and loan crash. So if you want to Google the savings and loan crash and see what that was all about, that caused that.
I heard about it. All right, well, let's move it along to wrap it up with this. I want your opinion. I'll give you my opinion, and then I guess we'll see what happens this year.
All right.
So what is your opinion? What's your prediction for what's going to happen this year? What's the mortgage market, and how do you foresee it unfolding over the next 2 to 3 years?
Yeah. So definitely I see rates coming down in the next few years. I'm sure this new administration is going to work towards, because he did it before. And the reason that they always want to try to focus on our industry more than any other is because our industry has the biggest economic impact for the nation. Housing and the money being borrowed for housing, and then all the things that go along with it, purchasing furniture and a new roof and an AC and blah, blah, blah. All these things stimulate our economy more than any other market. So they always got a bullseye on our market trying to get it stimulated and going. This new administration obviously knows how to do that, and that's why we like the student administration, because they are business savvy. They're not they're politician savvy, but they are even more business savvy, and they know how to make our economy work, and they know that our industry is one of the key components of that. So I believe this administration is going to make that happen for us. I think rates are going to come down. As we saw right after the election, we already saw a lot of consumer confidence just in the stock market alone with it rallying the way it did. We're already seeing numbers on the report that I sent you guys the other day about how they're saying the housing market has taken off way sooner this year than has in previous years and the average years.
That's a good sign.
Yeah, that's a good sign. We've got some inventory right now. Rates aren't horrible. There's doable deals out there. There's all kinds of doable products that are coming out that make not subprime, but they kind of feel subprimey. All this non-QM stuff, but it helps to get people in houses. And I think the bottom line is here's the main bottom line. Main bottom line is the demand is still there, and the demand is never going to go away. It's always going to increase. Why? Because we're like rabbits. We're all multiplying like crazy, and we've got
we got to live
families,
somewhere, right? Yeah,
and more people need housing. And with hopefully they help us with the building market and getting building prices down, so that these builders will come out and build more houses, because there are just not that many builders out there. It doesn't pencil for them, and so we're relying on inventory from people selling their homes, which people don't want to move and sell.
Right.
We're relying on inventory. So hopefully they stimulate that part of the economy too, to get builders working. But the bottom line is there's demand. People need homes and they're going to buy it. And like we always say, don't worry about the interest rate. Date the rate. Marry the house.
Man, some of these people have been dating for a long time the past few years.
A couple of years. That's nothing. I mean, if you look at the whole spectrum of things, it's really not that long. You want to get in the house now, because if you wait till the rates drop to buy your house, well, guess what? There's the demand. Everybody's going to
right. No, I'm right there with you.
Yeah, the house you're trying to put for $500,000 is going to go to $575 when the rates drop. So buy the house now. Keep that $75,000 equity growth when the rates go down, and we'll refi you later and get you a lower rate.
Right.
Lower payment.
Not to mention they'll be going up against other buyers and multiple offer situations again.
Exactly.
And getting that property bid up.
Yeah. And then they're going to start offering above and beyond asking with cash. Who's got the cash to do that?
Exactly.
Get your house today. We'll refi it tomorrow. Don't worry about it.
It's easy for them right now. I mean, we do a lot of the real estate side too, and it's like there's no competition. A lot of these houses are sitting on the market right now, so they can go in, get all the concessions they want. They want to get closing costs, covered, a huge credit to buy the rate down. There's so much stuff they can do right now.
Yeah.
They're not going up against other people.
And here's one thing I like to do for everybody too, and I encourage you to do it for yourself in your own home or your parents' home or whatever. Look at when you bought your last home or the first home you ever bought. Look at when your parents bought their home. Look at the amount of equity growth it's had from the day you bought it or they bought it to today.
Right.
You're missing out on all that equity growth by waiting. And the rates going down is just going to cause you to lose a big chunk when the price goes up. So if you look at, like we just did a scenario for somebody who had their house they bought it, I think it was 2013, and they already had like $100,000 of equity growth. That equity growth is still going to happen. We still have up and downs in the market, but if you look at the long trend, the 70 years, 100 years, it's always still an upward trend. So your home's it's appreciating asset. It's going to go up. Get it now. Maximize the amount of equity you can build in it. Don't wait for the rates to go up. You're going to shoot yourself in the foot by paying a higher price, losing that equity growth.
Love it
today.
Yeah, love it. Yeah. Well, myself too. I think I'm pretty optimistic about the upcoming year. I think it's actually, I'm going to go out on a limb and say we're going to be mid-fives. That's what I think. I hope so. I think the current admin coming in is going to do some stuff to really shake it up, as far as the rates go, and they're going to do some stuff that's unconventional that we don't even foresee probably. Yep. That's what I think, and I just think the next 4 years is going to be great.
Yep.
So anyone out there who's on the fence about purchasing, make it happen. It's going to create generational wealth for you, your family. And you stick into a rental for the next few years, you're gaining nothing. You're paying 100% someone's freaking mortgage.
You're actually building the landlord's equity up, not your own.
Exactly. So
don't do that.
I think it's going to be great. I'm looking forward to it. Anyone who's looking to get their loan officer license or getting into real estate, contact us. Hit up Kerrick. He's a phenomenal mortgage mind. Do you have any questions? You want to pick his brain? But yeah, other than that, I think it's going to be a killer year.
Yeah.
Looking forward to working with you, building my mortgage career with you as well, and learning from you, man.
Yeah.
Thanks for coming on the show. And
of course, I love it.
We'll see you at church on Sunday.
Next time. Cool. Right on. Good luck, everyone.
Take care, everybody. See you in the next one.